Welcome to Global Tax Talks. I'm Will Morris, and I'm here in Toronto, Canada, where I'm delighted to be joined by Selby, an international tax partner here. Cara, welcome.
Thank you for having me.
Great. So this is all going to be about Pillar 2, because of course everything is about Pillar 2. So Canada's legislation to implement Pillar 2 was enacted last year, and there's a proposal for a UTPR and a UTPR safe harbour to take effect this year. So can you give us a sort of status update on where the implementation stands and what may be on the horizon?
Sure, Will. You're correct. The Canadian Department of Finance released draft legislation to implement the UTPR, including the UTPR Transitional Safe Harbour, on August 12th, 2024. The draft legislation applies retroactively back to January 1, 2025. So in terms of enactment, the timing's uncertain due to the prorogation of Parliament until March 24th. This is due to the Liberal Party's search for a new leader following Prime Minister Justin Trudeau's announcement to resign. Therefore, the opposition parties can't trigger an election in Canada with a non-confidence motion before the Liberals have a new leader. For the moment, all parliamentary business is on hold. So what I can confirm is nothing will be enacted before March 24th. In terms of what might be on the horizon, well, all I can say is we're in unusual times, given the political environment in the US, and in particular, given the global trade deal and the American First Trade Policy executive orders that were signed on Inauguration Day. We know that these executive orders propose retaliatory measures against countries implementing the tax regimes that have extraterritorial effect or discriminatory effect, such as UTPR and Digital Services Tax, which the DST is enacted in Canada. Whether that's sufficient to force Canada's hand to enact the UTPR or to not enact the UTPR or repeal the Digital Services Tax, well, we'll just have to wait and see. It's impossible to predict.
All right. Yes, there will be a lot that unfolds over the next few months. Much of it, as you say, not predictable. Great. So look, Pillar 2 is creating significant complexity for multinationals, both in Canada and obviously across the world. And data remains one of the biggest challenges, both to withstand audit scrutiny and to reduce exposure to penalties and interest. So where are companies in their compliance journeys? Are there some common themes, approaches to addressing Pillar 2 compliance obligations? And are there any sector-specific considerations that you've come across?
Well, Canadian multinationals are moving at different speeds in preparation for Pillar 2. Most companies have been focused on estimating top-up taxes to report in their consolidated financial statements, which means they've been prioritizing materiality over accuracy and taking certain shortcuts in their data collection and calculations. Others are creating enhanced charts of account in their ERP system, tactically applying automated data extraction tools and transforming the data into a format that can be ingested by their calculation engine, which is a pretty good start. Some clients have also started with a proof of concept, which is a really powerful way to build confidence in your Pillar 2 data strategy. It can be overwhelming to gather more than 280 data points per constituent entity that are required for the Pillar 2 all in one go. Calculating the impact of Pillar 2 for a jurisdiction in which you can't rely on a safe harbor simplifies the initial data calculation. It also lets you measure the time you've saved through automation before scaling the proof of concept across the group. So since 2024 is now over, companies should shift their focus to the compliance burden, which means collecting the data to finalize your country-by-country reports, determining what jurisdictions can rely on the safe harbors, and then completing the detailed Pillar 2 calculations all well in advance of the filing deadline. The sooner the better, as companies shouldn't underestimate the compliance burden to file the Pillar 2 Global Information Return. Not to mention, here in Canada, the first year for filing Pillar 2 for the 2024 calendar year ends is the same as our corporate domestic tax returns. In terms of sector-specific considerations, in the financial industry, which includes banking, insurance, private equity, pensions, etc., we've experienced challenges in gathering data to make entity classification determinations. for example, is the specific entity an excluded entity, a reverse hybrid, a hybrid entity, an investment entity, or an insurance entity? I could go on.
Yeah.
There also have been a few significant challenges in the private companies segment in terms of determining who the ultimate parent entity is. Quite often, the ultimate parent entity doesn't prepare consolidated financial statements, and the country-by-country report has not historically been prepared based on the ultimate parent entity. In this case, data simply does not exist and needs to be created.
I have to say, every time I hear this, that the amount of complexity that we've managed to engineer seems to be disproportionate, shall we say, to the amount of revenue that may end up being paid. But there we are, just saying. We'll see.
Agree.
Okay, so let's shift gears now and talk about the deals landscape. And tax considerations, obviously, have also been an important part here. But Pillar 2, again, may add significant costs, complexities, and risks to a deal. So can you tell us what you're seeing in the deals market and how companies can better prepare for that?
And in the deals market, Pillar 2 just adds a new layer to the whole due diligence process, the modeling of the tax implications, and its structuring. If the impacts of Pillar 2 are not considered up front, it can result in some unpleasant surprises.
Right.
For example, a transaction could push some groups beyond the threshold of 750 million euros in annual revenue, causing them now to be subject to Pillar 2. This can then double the group's tax compliance costs following a deal. It's also important to understand how the data is being sourced for Pillar 2. If the target has trouble extracting data or it has to draw it from multiple ERP systems, the buyer may face more costly and time-consuming integration process before it can actually perform the Pillar 2 calculations for the newly combined group. Once the target shares the necessary data, it's important to model the target and its subsidiary as part of the buyer's group, not on its own, to understand the Pillar 2 implications of the transaction and its jurisdictional blending results. In particular, buyers can't rely on a target's classification as a low-tax constituent entity when it forms part of the vendor group because of the jurisdictional blending. A target may be a low-tax constituent entity in the vendor group, but not a low-tax constituent entity in the buyer group, or vice versa. So, for example, Canada and the US may be assumed to be high-tax jurisdictions, but they may not be due to various credits, green energy incentives, and capital gains exemption in Canada.
Right.
It's also important to consider alternative deal structures to account for mismatches between the local tax characterization and the financial accounting characterization, because the latter forms the starting point for Pillar 2. So, for example, the cost-based step-up under the bump rules in Canada is frequently used by foreign buyers of Canadian target companies. The Canadian bump rules allow for the step-up of the inside basis of the Canadian target's capital assets for tax purposes. Where no Canadian tax is imposed on the vendor's gain because of the bump, the Canadian tax characterization of the gain may depart from the financial statement characterization. This essentially means that there'll be no basis step up in the underlying assets and no recognition of related deferred taxes for Pillar 2 purposes. Clearly, the complexity of the Pillar 2 rules makes modeling and scenario planning a necessity. And not only that, this needs to be done lockstep with the financial accounting characterization in order to avoid the unpleasant surprises.
Right. The world gets more and more complex. Cara, thank you so much for joining us. This has been great. And I think we may need to come back and get an update on this in a short while. But again, thank you so much for joining us.
Anytime. Well, thank you.
And thank you for joining us. And come back next time so that you stay global tax ready.